All the budding investors. Stop for a moment now and lend your ears to what I've got for you. Don't rush and end up leeching yourselves up by some random fraudsters who are waiting to pounce on you at any given chance. You should be vigilant enough as new investors and make yourselves wise to a roundabout of many particulars before you venture into a whole new world of investment. Some strategies to adopt, some set shrewd ambitions to envision pre- and post-investment are some of what I have for you to gobble up straight and then throw them up per se for good investment results. Hey go-getters, welcome back to The Early Investors, another profitable episode where you can learn how to become financially free. In today's video, we'll be showing you some investing tips for beginners from the teachings of Peter Lynch. Want to become the next Warren Buffett? Stay with me to find out all the tips and tricks to save your hard-earned simoleons. Before we jump into the video, make sure to subscribe to our channel for more business-related content. Peter Lynch, chairman of Lynch Federation, is an investor, mutual fund manager, and philanthropist. He is by far one of the greatest investors. For the 13 years that he had managed the Magellan Fund at Fidelity Investments, he stretched up to an annual average return of 29.2%, which, as of 2003, had the best 20-year performance of any mutual fund ever, invariably more than doubling the S&P 500 stock market index. Asset under management, AUM, with his philosophical management, surged from $18 million to $14 billion. He has coined several investing mantras of modern individual investing strategies. He himself has put out some strategies for us to adopt, and it's high time that we learn to earn like him. Alright now, let us take a jaunt of his investing theories, and don't forget to make the precise use of the tips that can sit you up on the top tier, just like our investing god, Peter Lynch. Invest in what you know. I have found that when the market's going down and you buy funds wisely, at some point in the future you will be happy. You won't get there by reading "Now is the time to buy," Lynch says. Lynch's investment philosophy is summed up, buy what you know. And there's some truth to that, and also it's often way oversimplified. Lynch uses this principle as the starting point for investors. He always emphasizes on individual investor approach rather than fund manager approach, because individual investors can spot suitable investments in their day-to-day lives. He invested in the shares of Dunkin' Donuts, not after reading about the company, but after being impressed by their coffee as a customer. That's a clear example of a ground reality performance check. 10-bagger approach. Being a baseball geek insisted him to coin the term 10-bagger, which represents 2 home runs and a double. In financial terms, it is an investment that appreciated to 10 times its initial purchase price. It is used to describe stocks with bombarding growth prospects and has the potential to increase tenfold. A mixture of market research and quality experience is a prerequisite for finding 10-baggers. A growing industry shall have more potential 10-baggers than a mature industry with already established players. Behind every stock is a company. Find out what it's doing, says the writer of 3 books. In a way to create a domino effect, Learn to Earn was written for beginner investors of all ages, mainly teenagers. In 1UP, Lynch outlines his strategy of buying all kinds of stocks like growth, cyclical, and potential turnaround situations by giving particular emphasis on discipline, by rechecking your stocks every few months and not panicking when everyone is selling. An average investor can beat the money managers at their own game if they invest the necessary time and effort in researching stocks, exercising common sense and discipline. According to his practical experience, one should always count on specific characteristics of a company. Value investing strategies. He states the company's duckling nature tends to be reflected in the share price, so good bargains often turn up. If there are some negative rumors around the company or disagreeable statements against the company, a higher level of attention should be given to such companies. Companies under M&A deals. Investors should focus on companies participating in a proposed M&A transaction. A further check should be done on the insider buying and take advantage of such volume. In most cases, M&A deals have huge potential to generate returns because of the synergies of the combined entity. Focus on market leaders. company in a niche business segment having a controlling market share has larger visibility of future profits and sustainable growth because of the barriers to entry in the niche segment. Defensive industries. The company that provides all-season usable products like drugs, eatables, or soft drinks provides stable earnings and regular dividend payouts. They would be a good hedge to the portfolio in times of recession. Track insider buying activity. Lynch believed that insiders/promoters buy a stock only when they are confident of the company's long-term prospects. No analyst coverage. A multi-bagger stock is identified in its initial phase before it catches the eye of analysts of the streets. Such companies are often neglected by the market participants and therefore offer value buying in such companies. Now, let me show you the Peter Lynch learnings on what a company should not have. 1. Companies with big plans that have not yet been proven. 2. Few buyers account for 25 to 50% of the company's sales, concentration of customers. 3. A company over-diversifying its operations and acquisitions into non-synergistic businesses. Financial investments and not strategic investments are not preferable. 4. Hot stocks in hot industries rather than hot stocks in dull industries. Well, we are now furbished with the investment strategies, but what to do post-investment? The thing is, you can do anything. You can either end up on the wrong side, losing all your hard-earned simoleons, or on another favorable side that will boost your earnings and shade you on a long run. Well, the choice is all yours. Your money cells either shrink or duplicate. So, to know what to do when, to have always laid on a bed of bucks, here are some post-investment lessons from our grand old master of investment, Peter Lynch. Diversification of portfolio. Do not diversify just for the sake of diversification. Complete research on the market and stocks is essential. Diversification comes at a cost. Over-diversification will affect the overall profitability of the portfolio. Price drop scenario. Buy on dips has been a well-tested outperforming strategy. However, one needs to understand the price drop. As per Peter Lynch, price drops in a bearish market is a buying opportunity, whereas a price drop in a bullish market is a selling opportunity. Stay in the game. A long-term commitment towards stocks will deliver exponential returns. Using the above principles, the investor must hold the stock for years, fulfilling the 10-bagger approach. Regular review of the portfolio. One should recheck one's portfolio regularly, depending upon the investment appetite like weekly, monthly, or quarterly. Sell if the stocks have played to your expectations or it fails as per your fundamental analysis. Lynch doesn't see smartness in getting into a company that's going up, then taking their profits rather than hang in with the very high stocks when you sell the great companies and add to the losers. It's like water in the weeds and cutting the flowers. You have to know what you own and why you own it. This baby is a cinch to go up doesn't count. Bonus info. In order to have a sound knowledge on investing tips from Peter Lynch, you guys can go grab the Mutual Fund Superstars book that he penned down along with the author John Rothschild. In it, an insight into the basic principles of the stock market and business in an investing guide are explained as much as possible. This will enlighten and entertain anyone who's high school age or older. Many investors, including some with substantial portfolios, have only the sketchiest idea of how the stock market works. The reason, Lynch and Rothschild say, is that the basics of investing, the fundamentals of our economic system and what they have to do with the stock market, aren't taught in school. At a time when individuals have to make important decisions about saving for college and 401k retirement funds, this failure to provide a basic education in investing can have tragic consequences. For those who know what to look for, investment opportunities are everywhere. The average high school student is familiar with Nike, Reebok, McDonald's, The Gap, and The Body Shop. Nearly every teenager in America drinks Coke or Pepsi, but only a very few own shares in either company or even understand how to buy them. Every student studies American history, but few realize that the country was settled by European colonists financed by public companies in England and Holland. And the basic principles behind public companies haven't changed in more than 300 years. In Learn to Earn, Lynch and Rothschild explain in a style accessible to anyone who is high school age or older how to read a stock table in the daily newspaper, how to understand a company annual report, and why everyone should pay attention to the stock market. They explain not only how to invest, but also how to think like an investor. Crikey, that is a lot of information given out to you on how to invest as budding investors and how to deal post this first level of investment. I hope you all have been equipped now with all the investment tips and hacks you need to save yourselves from a money dip. So, bear these instructions in mind and work wisely. Give us a like if you find it info-worthy and tap the bell icon beside to stay notified. Cheery bye!